Maureen Bory,
Here.
Chris O'Regan,
Here.
Christy Hilton,
Here.
Artie Bryson,
Here.
Cindy Valentine here.
Okay, looks like we're all here. On the agenda, I have public comments. Do we have any public comments for anybody? Hearing none. We're gonna move right into our new business. Why we're here is a presentation of the bonding the pension liability. And we have with us Northland Securities, Bill Roche and friends, Tom and everybody else. So go ahead and take it away. One of our trustees is brand new, Maureen, Bill.
Okay.
And she knows nothing about this. And I'm sure she's like a deer in the headlights. And I was just gonna say, this could be complicated. So talk to us like we're third graders.
Sure, no problem. A number of years ago, the state of Michigan allowed or prepared legislation that allowed municipalities to go out and issue bonds to fund their unfunded pension and OPEB or healthcare benefit costs. And sort of Oakland County, and Tom has some history on that too, was probably one of the first ones that was done before the official legislation was put in place. But by going out and selling bonds in the market, really what the township and other municipalities are doing is hoping to take advantage of an arbitrage play where you can go out and borrow. It's done on a taxable basis and use the bond proceeds to put into your pension or into your OPEB fund and bring that funding up to what used to be 100%. The theory is that you borrow all that money, put it into the account, and you're paying, in this case, we're estimating right now about 3% as your borrowing cost. And if you're earning 6.5% to 7% in the market, you've got an arbitrage positive spread over what you're borrowing for and what you're investing at. And then that gets you up to 100% funding. Michigan's a little bit different than a lot of other states that have looked at this. And a number of other states, pension and OPEB funding was looked at on a negative basis because, say, for example, in Illinois, they would go out and borrow money, and part of the borrowing would include the payments they were supposed to make to their pension and OPEB contributions this year. And those pension and OPEB agreements were never closed out. When it was put in place in Michigan, the municipalities are required, in order to go out and borrow, you have to have closed those pensions. So what that prevents is municipalities from bonding for an obligation, putting that money into an account, and then say 2 years from now, a new township board, a new city council decides to change the multiplier for the cops or firemen from 2 to 2.5. So now the obligation is even bigger than what it was before, and now you've got all this debt on the books. So Michigan's one of the stronger states, I believe, in regards to the funding of pension and OPEB obligations, in that one of the requirements is you have to have those pensions closed out in order to go out into the market and bond. And if at any time you have any questions for me as I'm going through this, feel free to kick in, and yourself as well, Tom, from the legal standpoint. So
We are all closed. All of our plans are closed. Maureen, did you have something?
Yeah, that was my question. When you say closed out, does that mean they're retired already?
No, that means the plan is closed. Nobody else can join.
Oh,
So you have in lieu now a 403B type plan.
all right. So new employees are not getting pensions like most companies. Okay.
Right.
Correct.
Typically, you've gone from defined benefit plans to defined contribution plans, right? So you've closed out the existing plan to new hires. They're in the plan. And so we're trying to just make sure we're providing for the proper funding of that. And as Bill said, a lot of times it is that, the arbitrage, that's the difference of what you're paying out on your bonds to what you're earning on those funds. And then also kind of a leveling out of those payments too. I mean, you know, a lot of times MERS has some pretty big spikes in how their plans look. So this allows you to kind of level out those payments and still meet, you know, your annual your required contributions. Just to be clear to the board and Maureen, for your benefit. So just on roles here. So Steve and Bill are with Northland Securities. They're kind of financial people, right? So they're gonna structure, look at all the financial analysis. I'm actually with Miller Canfield. I'm a lawyer. I represent the Township as bond counsel. So my responsibility is to make sure that you're legally following all the rules, all the statutes associated with how these bonds can be issued. Because as Bill said, it's a very specific piece of a statute that authorizes this. There's lots of steps and the presentation covers most of those. But just so there's a distinction of roles of I'm your legal advisor, Bill, Steve, kind of financial advisors in working through the economics of whether this makes sense or not. So just so you have a good understanding of that going in.
So could somebody explain to Maureen, probably a little bit better than I would, the difference between the defined benefit and why we closed it to go to a defined contribution?
In general, a lot of municipalities are looking at closing out their defined benefit plans simply because of the unknown liability that the municipality has. So the lack of funding, if you would. A lot of defined benefit plans have not been funded properly because the market has moved. We've had various market crashes throughout the years. And costs for healthcare benefits, the contributions to the pension plans have been generally higher than what it exceeded. So with a defined benefit plan, you never really know what your actual contribution is going to be. But in a defined contribution plan, such as a 403B, if you contribute 8% of the employee's payroll, that's your obligation. You have no other liability. But if you made an obligation to me, and I'll use the example, my dad was a retired firefighter for the city of Detroit. He retired in 1986. He lived to be 96 years old. He got his money from the Detroit pension fund because he lived a fairly long time. Other people, a good buddy of mine died after a year after he retired. So even though you have the actuary putting in plan an estimate as to what that liability is based on many different variables, such as how long do the people live that are in the defined benefit plan? What are the actual interest income assumptions on the earnings? So a lot of that, even though you may fund it, the contribution to the pension plan, if those variables change from what the actuary is currently assuming, you still have a liability. And that sort of gets into why one of the state's requirement is you have that plan closed down. So now you can't manipulate or change, the multipliers that a policeman or fireman would use, right? From 2 to 2.5. Only things that can change in there are how long are they going to live? I shouldn't say the only things, but some of the major ones are the actuarial assumptions on the longevity of the participants and your investment performance. So even though, and we'll get into this a little bit later, even though we would fund the pension liability and potentially the OPEB, you still are on the table if those assumptions that are in the actuarial plan don't meet the obligations of the plan. The township is still on the hook to make those payments to those beneficiaries as long as they are in existence, those individuals. Anything wrong there, Tom?
No, and again, I mean, just generally, the idea is those costs are kind of uncontrollable. So a lot of communities and the state strongly encouraging the closure of defined benefit plans. And you'll see a lot of businesses are starting to, or have been for years, moving away from defined benefit plans because of the costs associated with them and trying to move to the contribution plans to be able to manage ongoing costs.
Thanks, guys.
So as part of let's take you through page 1, which is the general steps for doing a pension and potentially an OPEB bond issue. So we're really in step 1 right now, trying to quantify whether or not there's any potential savings to the township by closing out the pension and the OPEB. We've looked at initially the feasibility of closing out the pension plan. And the new state statutes require that you can only fund 95% of your liability in the pension plan. And we've done some preliminary numbers, which I can get to later, that show that we're funding that and we're meeting some of the targets that are legally required. So we have the down and dirty analysis there. You do meet the requirements that your defined benefit plans are closed. We've got a preliminary review of the pension that shows you meet the savings requirement established by the state, which is 20% PV. And then we've got eventually comprehensive financial plan would be made available to the public. So the steps that we're going through right now, we still need to complete the calculation of any potential savings for the OPEB, and we're working on that right now. If it comes back that the savings are there for the township, then the township would make a decision as to whether or not you want to go into the next steps, which would be comparing what is called a comprehensive financial plan. It's a very detailed layout of what your defined benefit plans are and your OPEB plans, who the participants are, what your obligations are, how many people participate, what's going to be funded, the actuarial assumptions, all of that gets laid out. And then we do software and cash flow modeling to test the savings requirements to see if you generate savings based on the current market assumptions. And then the state has us do sensitivities on those as well. So if you are comfortable with the first assumptions that we are meeting those estimated savings targets, then the next step would be preparation of comprehensive financial plan.
And Bill,
If
before you
that
go on to
looks
that,
good.
just for clarification purposes, there's two savings thresholds, and they're different for pension bonds versus the OPEB. The pension savings threshold is 15%, and then the OPEB threshold is 20%. So they are slightly different. I think, Bill, your preliminary analysis showed that, again, on the pension side, you're within that threshold saving, you meet that hurdle. But nevertheless, just to keep those clear, that one's 15% for pension, the other's 20% for,
20%,
and that's a statutory net present value saving. So if the numbers show that you're at 10%, you couldn't proceed to actually, issue bonds for this purpose because we don't meet one of the statutory thresholds.
Correct. So if we move on, and then we will work on the preparation of the comprehensive financial plan. That plan would be submitted to Treasury, end up meeting with Treasury, prepare the bond resolution, a notice of intent. Tom, I'll let you go through the legal requirements.
Yeah, so again, as Bill said, the main key, what's different than a lot of other bond issues, before we do, so there's really two main points that will come to the board to discuss. One is the approval of this comprehensive financial plan, and as Bill said, it's comprehensive. It covers everything that your residents would want to know about how the township's dealing with your pension and OPEB obligations. And then it also goes into details as to what's the township's debt margin, because we're issuing debt. They want to make sure within those thresholds. And you're required to adopt that plan before we even publish our notice of intent. So what ends up happening is that if the board wants to continue with the preparation of that plan, we'll then present that to the board for approval. Once that gets approved, it's required to be posted on the township board's website. And then we actually publish, along with that same approval, we'll authorize publishing a notice of intent in the paper that says the township intends on issuing bonds for this purpose, amounts not to exceed X amount of dollars that we would put in, and the duration of how long the bonds could be outstanding. And then with that comes the right of referendum. So if the residents don't want you to issue bonds for this purpose, they have 45 days to submit a petition signed by not less than 10% of the registered elected in the township to actually stop the township from issuing those bonds. So, but once we get past that time period, as Bill said, we would actually adopt a bond resolution, which specifically authorizes issuance of the bonds. The publication of the notice doesn't commit the township to doing anything. It just says, hey, we intend on doing this, and we want to provide that right of referendum. Once we pass that, again, we'll come to the board for an actual bond resolution, which talks specifically about how much are we going to do? When are the bonds paid? What's the security for the bond? So it's a more detailed resolution. And then once that's done, we file with the Department of Treasury. Under state law, the Department of Treasury for Michigan is required to approve these bonds. It's the only type of bond issue where they have to specifically approve the issuance. The other deals that we've done for the township, we haven't gone to them for specific approval, where we actually file an application and they authorize that issue of bonds. This requires them to do so. So they really review the comprehensive financial plan and all the statistics that go along with that. Your actuarial reports that you'll get from your whoever's doing those for you. All the financial analysis that Bill and Steve will do for you from Northland Securities. That's all part of that plan. And then you want to make sure that we're addressing all the other requirements under the statute, which we build into that plan. So once we get Treasury approval, then we can go back into the market.
Yep. And that is sort of the easier part, more that you're used to in issuing bonds. Once we have the Treasury approval, we work on preparation of the official statement, confirm the structure of the bond issue. And as Tom has indicated, the requirements are we go with generally level debt service, and you're not going to run the payments on your unfunded liabilities longer than what they're currently budgeted for in the actuarial assumptions. Then we would sell the bonds and deposit the monies into MERS or the trust for the OPEB.
So just if I could add to that, so for Maureen's benefit and for the benefit of the board, when Bill uses the term official statement, what that means is when we go out to sell the bonds, or actually when Northland Securities goes out to sell the bonds, there's going to be a document. Think of it as a prospectus if you're buying a stock. It's a document that describes the bonds themselves. You know, what's the dollar amount, what's their security, when are they paid. It also has a section exclusively on the township. So if I was an investor from California and I had no idea about Clay Township, I could look at that section and it has all the relevant information, where you are geographically, what your tax base look like, what are your major taxpayers, what are your audits part of that document. So it gives me as an investor, or would give me as an investor, a good idea as to the financial position of the township. So it has all the information in that document that I would need to make what's called an informed investment decision. So it takes a lot of time to put that together. You know, Bill and Steve and his shop will help gather all that information and put that document together. We will sit down with certain of the township officials, certainly, you know, Artie and Cindy, and to go through that document and ask specific questions with respect to, you know, the information that's in that document. And of course, we would have Christy would be part of that too as treasurer, and kind of review that, do due diligence before that document gets sent out.
And once again, please feel free to kick in with any questions at any time if you have them. The next page, page 2 of the presentation, gives you the calculation that we did looking at all your closed defined benefit plans. So we've got them all detailed out here based on what the actuarial liability was for the plan. The maximum funding level right now under the statute is you can bond for 95% of that liability, or the unfunded liability. So for each of those plans, you have, looking at DPW, you have a maximum unfunded liability of $746,000. We added estimates to cost of issuance for the bond issue to that, which shows an estimated bond amount for each of those plans of say 776 here for DPW. For the Police Officers Association, it's roughly 638,000. So each of these plans would be funded, and I believe they're all separate plans, correct, Artie? So we would have these all broken out. So each amount of these proceeds would then be deposited into those separate plans to bring the funding level up to 95%. So if we carry that throughout, you're looking at roughly a bond issue of about $4,235,000, and that was based on the actuarial report of December 31st, 2019. So if we update these numbers, as your actuary will be coming out with another report shortly, if we look at and remodel this based on a 2020, those numbers would change based on that actuarial report. But as of right now, that would get you the requirement of funding it up to the maximum of 95% of your unfunded liability.
And as Bill
We
said,
would keep
Treasury will
individual-
require us, oh, sorry, Bill. Treasury will require us to use the most up-to-date actuarial reports. So because there'll be another one coming out. Now, Artie, I don't know when you would get that, December 31. I don't know when that typically would arrive.
No, well, is it at end of June or December or they do that? Do you remember, Cindy?
We get one,
Yours is
usually-
that-
it's usually the first week in January.
Yeah, okay. So we'll be getting one soon then.
Yep,
Well,
so
that's
we
good,
would
'cause that'll be
update this
fresh.
with new numbers.
Right.
But it gives you an idea of, and it'll actually be better off because the state's changing some of the actuarial assumptions that the actuaries have to use. So using December 31st, 2020 numbers it'll be better to use more recent numbers than these other ones that are a year old. But that just tells you right now, based on the December 31st, 2019, and this is just for the pension portion, you're looking at about $4,235,000 to fully fund that obligation. Or I should say fully fund it, but fund it at 95%.
Right.
Your OPEB liability is approximately $2 million. We're still working on that. And you're only allowed to fund up to 60% of that liability. So if OPEB were to work, you might be looking at an additional 1.2 million that would be bonded for.
But I do have a question, if you don't mind.
Yeah. Mhm.
So the cost of bond that you have spread across here is divided equally between all these divisions. Is that just an arbitrary number just for simplicity's sake?
Yep, just an arbitrary number for simplicity's sake. Yeah, in theory, when we actually do it, it'll be allocated based on a percentage basis.
Okay,
But
Yeah.
I just randomly took it for simplicity's sake.
That
okay.
was my question too, because it's the same for 4 million as it is for 800,000. And then it doesn't, the grand total is really 210,000, but it says 205, so, okay.
Little rounding factor.
Okay, well, I was just having a hard time bonding out 40,000 for $30,000.
Yeah, I just randomly took 30,000 and allocated it.
Okay,
That's a
If I was
task
as
built
good
into the
at
presentation.
Excel as Steve, I would have done it on a percentage basis. Then the next page sort of gives us the meat of the matter. That is really the first test the township would have to meet in order to proceed. It is the present value calculation where we see, are there potentially any savings by bonding out your pension liability? So we took the bond amount of $4,235,000, and I believe our interest rate here was 3%, correct, Steve?
Yes, that is correct.
Okay. So we took the debt service projected to be paid out on your bond issue over the next 19 years and compared that to your budgeted current estimate for your pension contributions. And there's no inflationary factor in here. We just took a flat 477,252 and ran that out. So comparing your total cost for the debt service on the bonds versus the pension contribution, you can see the annual savings over on the right starts at roughly about $60,000 a year to the township. And then we have to calculate the present value savings of that using the true interest cost on the borrowing, which is 3%. So in looking at the present value, the requirement for pension bonds is 15%, and you meet that target, we're at 19.37. So at least based on our preliminary analysis, you meet the target and you could proceed to the next step.
I would guess too that we bond out for a lot cheaper than 3% interest, a lot better interest.
I would think so, but one thing you have to remember, Artie, is that in selling pension bonds, these do not qualify for tax exempt bonds.
Right.
You have
they're
to sell them as
taxable.
taxable bonds.
Gotcha.
So the interest rates will be higher, and we've got some information on where rates are. But that's why a lot of municipalities have been taking looks at this. just to close out. For others that had not already closed out their benefit plans, some of them just use this as a negotiating tool, if you would, that, well, we're going to close it out, but we're going to fully fund it. So you don't have to worry about the city or the township or the county making payments 10 or 15 years in the future, because all that money will be in the account. So based on this calculation, we do meet the target of 15% present value savings. And based on our estimates, the township would be looking at roughly $60,000 a year in budgetary relief on the pension side. And if there's any questions on that, we'd be happy to answer them. All right, with that, we'll go to the next page. This legislation will sunset in December 31st, 2023. So we've still got 3 years that the township could do this unless the legislature were to extend it again. And in regards to some of the requirements, there were a number of changes that were made by the state from the original legislation to Act 575. And you've met a number of those already in that you've already closed out your plans. So that is taken care of. You don't have to worry about that. You have to have an A rating or better on your bonds. And right now the township is AA rated. So we've already met that requirement. You've got more than enough legal capacity to issue the bonds. There is a requirement, and I don't think you meet it, in that if you have 100 or more participants in your plan, or active or retired, you have to do a study to make sure that only people that are receiving benefits are actually receiving benefits. But I think based on the actuarial reports, there's only a combined total of 84 between the various plans. So it looks as if you don't meet that. So these are some of the steps that would continue to be met as we would proceed with the transaction. And then obviously the biggest ones are meeting the targets on the savings.
Artie, that sounds right. You have less than 100 current members in the plan?
I believe so.
Okay, good.
We would probably have to verify, but I believe so.
Great. Because as Bill said, otherwise there's an additional step that, you need to kind of do an internal audit as to making sure, they study that they're getting the benefits and a list of that. So to the extent we
Right.
don't have to do that, that's great.
I believe we're under 100 for sure.
Perfect. Thank you, Cindy. Yep.
Thank you. The next page just gives you an idea of the municipalities that have done OPEB or pension bonds really over the last 7 years. And once again, Oakland County was sort of the first one to do it before the true legislation was in place. I don't have the detail on it. I have to get it someplace else. But a number of these that were completed prior to the changes in 2018, correct, Tom?
Yes.
Yep. A number of them that did pension or OPEB would not be able to do them under the new updated act because they would not have met the 15 or 20% present value calculation. So you see a few less doing them now because of that savings requirement of 15 and 20%. Port Huron was the most recent one, and that was a pension bond.
Just to give you guys a little bit more flavor on this, you can see that so far this year, only Port Huron's done an issue. I'm actually working with a community that's about to sell bonds tomorrow, pension obligation bonds tomorrow. And they'll close at the end of this year. So there will be at least one other. And we're working with at least another 3 other communities that are considering, in the same process that you are, considering looking at this, analyzing, and they all have already approved comprehensive financial plans and are at the process of already going to Treasury and waiting for Treasury approval. So you're not alone in considering this. This seems to be a very good time because as the market is strong, interest rates are very favorable. So just to keep that in mind, that there are other communities that are looking at this exact issuance right now. Those all happen to be pension obligations that my office is currently working on, or at least I am. But nevertheless, you can see a number of these deals have been for OPEB also on this list.
And the next page gives you an indication as to, given interest rates right now, there's a much stronger benefit to you simply from your cost of funds than it was for individuals or municipalities that borrowed 2, 3, 4 years ago. You can see that this is based on the 10-year treasury rate, which will be sort of the peg for your borrowing cost. The 10-year treasury rate really got as low as 50 basis points or 0.5%. Now we're getting close to 1%. So your cost of funds, and once again, I think we were conservative where we estimated 3% based on a 19-year debt repayment schedule. But your cost of funds is very low. 2, 3 years ago, these were being done at 5.5%. So the spread between the investment rate and the cost of funds was much narrower. So if you're still able to earn 6.5% to 7% on your pension investments, the positive arbitrage to you is much better. So the cost of funds, historically low interest rates. I've been in this business for 40 years. I think you'd have to go back before I was born in the 50s to find rates when they're actually lower than they are right now. It's so from a borrowing standpoint, interest rates are very low. So you're accessing the market at a good time if you were to decide to proceed. And just in summary for you, if we do look at pension bonds, once again, you're only going to be able to borrow 95% of the unfunded liability. You have to have a 15% net present savings required. On the OPEB, we're running those numbers and updating that. You can only fund 60% of the liability on the OPEB, and you have to have 20% present value savings. Treasury will require they have level debt service on your bond issues. You really, other than there's only one other bond issue, and your final payment is in 2022, other than special assessment bonds for Colony project. So this would really be your major debt outstanding. So there's nothing that we would have to do to tweak it. And once again, the bonds have to have your final payment no longer than what your projected payments are under the actuarial reports. And then here's the caveat, Artie, if we have more than 100 combined active and retired within a year, you've got to do that study to make sure that, basically an audit, if you would, make sure that anybody collecting a benefit is absolutely required to or can legally obtain that benefit.
Okay.
Just for clarity purposes, when Bill's talking about level debt service, what he means is that the township's annual payment is about the same each year. And the reason for that is Treasury doesn't want you to kind of backload principal on the financing, right? So it doesn't want to kick the can down the road. What it does is the idea is to kind of have it leveled off so that you're paying the same amount annually for the life of the bond issue. That's a very common structure. Most transactions are done that way. There are a number that are done differently where you're trying to wrap this financing around existing financing. I think that's why Bill was talking about the township's existing debt and what that looks like. But for this purpose, Treasury is going to want us to actually have about approximately level payments each year. So we'll get those as close as we can. Keep in mind the bonds are in $5,000 denomination. So
And we want that.
We
We want that. I mean, the object is not to kick the can down the road. It's, we're in a strong financial position to take care of this debt, a lot of it now, and alleviate, who's ever here in 15 years.
Yep.
I'm not going to go over page 8 very much because we sort of talked about the comprehensive financial plan a lot. I think I'd like to just sort of skip to, let's go to page 10. To really get to the meat of the matter is what are the advantages to the township and what are the disadvantages? By issuing pension or OPEB bonds, you have the ability to fund your obligation for the pension at 95%, get that virtually fully funded, and all that money set aside. The interest rate that you're paying or borrowing at is very low compared to historic rates, and your assumed investment income should exceed that by a fairly significant basis, which provides that positive arbitrage. You now have a known funding amount that you have to meet each year for the debt service on that pension obligation versus every year it could, based upon different modeling assumptions, different investment returns, that payment could change for the district year after year, could be higher, could be lower than what we're currently budgeting. So the bonding for that gives you a fairly certain debt service payment each year. And it provides the employees with the certainty that that money is now set aside in the pension plan for them. The downside, if you would, is your pension and OPEB obligations. OPEB right now is pretty much pay as you go. And pension, you have the ability to adjust that. Let's say you're having a bad year, you're running a budget deficit next year because of COVID, your revenues are down. Well, municipalities have been known not to fully fund the required payment in order to soften their budget problems, if you would. Your investment returns could be less than imagined. If we're assuming 6.5% to 7% investment returns and the market tanks next year and you lose 20% of your value in the portfolio, that's a big hit. And once again, the township is still on the hook to pay those benefits to the beneficiary. So if your investment returns aren't realized, we still have the obligation to pay those beneficiaries. So that obligation is still there. And it, limiting your benefit to adjust the, or limit your ability to adjust the benefits in the future, that may or may not be a big impact to you since those plans are closed already. And most everything else now is being done under a defined contribution plan.
If we do nothing in the market tanks, it's gonna, our MERS payment would
It's going to
way
get
up
backed up
anyhow.
either way. Correct.
I know
Absolutely.
they average it over 5 years, but
Right.
I mean, we'd still be in the same boat, my point is.
Yep, absolutely.
I think worse, actually.
Yep. But, some people think, well, we put the money aside, so we're covered. No, you still have the obligation, or the pension plan does, to pay those benefits to the beneficiaries, regardless of what the investment performance has been. And
Right.
that's true whether you do the pension bonds or not. That's absolutely true. You just might have a little, well, they'll average that out over the years. Rating agencies, I think they look at Michigan a little bit different than they do some of the other states. As I said earlier, in Illinois, they're known for just bonding for it. They don't close the plans out. They bond for this year's contribution that they don't want to make, and then they amortize that over the next 10 years, which is literally just kicking that problem down the road. I think Michigan structurally is in much better shape. So for a while, these were looked at as a negative, but I don't believe they are, at least in Michigan, as much as they have been looked at in some of the other states. So there is a disadvantage. Obviously, you're borrowing a little bit of money, roughly 4.2 million here, to fund that pension at 95%. And if the OPEB were to work, once we complete those numbers, that might be another 1.2 million to fund your OPEB obligation at 60%.
My gut feeling is we won't qualify for the OPEB, but we'll figure that out later.
That's sort of my gut as well. I don't know, at 20% PVC.
Yeah. Hey, Bill, we lost your audio.
It looks like he's frozen.
Oh, yeah. He might have locked up and he might have to call back.
On page 5, all the other municipalities, some say OPEB, some say, POB or just pension. It looks like you know, the bigger counties, Oakland, Macomb, did OPEB. Does that mean they only did the OPEB and not the pensions?
Tom could probably answer that.
Yeah, some of them just decided because, again, some of them may have been better funded on the pension side, or their plans may not have been closed. So there's different factors involved as to why they would have done one versus the other.
The
So,
OPEB is the healthcare, do I have that right?
yes.
Yes,
Yep, that's retiree healthcare. Oh, there, Bill's back. Yep.
yes, sorry.
That's right. Yeah, that's retiree healthcare. Yep.
So we're looking at two separate things to fund.
Correct.
Yeah.
And as of
most
right
this
now, the
is-
numbers that you see are only on your pension side.
Right.
We haven't completed the analysis on the savings calculation for OPEB.
Okay,
So hopefully we'll have that done in a week or two. But yeah, it really varies depending upon what municipalities that you look at. Some municipalities, their pension funds have been well-funded. They've continued to make their contributions. And a number of them, the big hole was the OPEB side. So that really it varies throughout municipalities.
And again, as Bill listed on that sheet of advantages versus disadvantages, I think some communities are just, because of the uncertainty of those costs with respect to OPEB and the ability to change some of them going forward, some communities have decided not to do OPEB and just stick with pension, because you're locked into the pension costs, right? You're locked into making those payments, whereas you're not necessarily on the OPEB side. So, it's even more so you're turning a soft cost into a hard cost on the OPEB side.
yeah, I was just wondering if we were late to the party on that, because, they did it 6-7 years ago, most of them. But we
No,
probably
and I will say, as Bill said, I mean, your timing coming to the party is, the market is much better now than it was when all these others issued, over the past, 6-7 years.
And sort of an extreme example on the OPEB would be, let's say 2 or 3 years from now, we end up with universal Medicare and nobody has private health insurance. And you've got that obligation sitting there. You've got that cash sitting there that you literally potentially could have no obligation to make payments on.
Right, we're tied into it. Exactly.
Right, because you are going to make your payments to your bondholders, right? So
Yep.
that is another obligation that you lock in. So
Well,
that's another
It's also
factor.
important to point out that we had to close all these pension funds to be able to do that. And to do that, we had to negotiate that with all of the unions that we had to be able to close those. It wasn't
Yep.
just we could say, hey, we're closing them and move on. So it's not, we had to strategically plan and make them understand why it was important to close those and go to a defined contribution.
Yeah, so you've actually done the hard work up front already. A number of municipalities that are looking at this are doing the hard work of trying to close out those pension plans.
Yeah,
That's
that's
where
not,
heavy
like you
lifting
said, that's
comes
not a
in.
unilateral decision. That's a negotiation.
Yeah.
Okay, where are we?
How many different unions are we working with as far as the pension plans?
We have 5, but they're all closed. Everyone, we got them the last go around to close.
Okay.
It was a challenge.
Now, Artie,
Yeah,
if I look at page 2, based on the actuarial report, I've got 1, 2, 3, 4, 5, 6, 7 different
Yeah,
entities.
yeah, there's a couple different ones with the police. Some were richer than others. Let me go back
We had a
there.
couple of very small ones that were fully funded, so those were not put in the equation.
Right. And then quite honestly, there's a couple of them that are really far out of whack, like command officers, command and the POAM. Years ago, I'm talking 15 years ago or something, they offered early outs for people. And so they let them retire early and start collecting their benefits, and it was never funded. And that's why they got so far out of whack.
Okay.
That was before our time.
Hey, Bill, just a general flavor for, just to give the board an idea. I mean, so to the extent that the board decided, hey, we want to start moving forward with this process,
Mhm.
you're probably talking the earliest, I don't know, maybe 3 months, maybe 4 months, Bill. I mean, just because of, by the time you get the plan put together, it's presented to the board, that 45-day referendum period runs, we bring the bond resolution back to the board, then we file with Treasury. Treasury's been taking a good month or more to review the applications, the plans, set up meetings to go over that. And then we get into the market. So you really are talking a good,
April.
yeah, at best, right? I mean, so.
Yep.
Yeah,
if
page
everything
13 has
runs-
a sort of an outline of what the time schedule would look like. So if you were to tell staff, ourselves and legal counsel that yes, you'd like to continue on with the next step and begin the production of the comprehensive financial plan, we'd get to work on that. We would drop in there the numbers then as quick as we can get them from the actuary based on the December 31st, 2020 numbers. Meet with Treasury, get Treasury qualification, go out there, publish notice of intent, and then post that to your website. And after that is done, then we would begin the process of the market. So yeah, we're looking at, if everything went well, having bond proceeds and the market closed out sometime late June, maybe.
Okay.
What's the initial hit on our budget at the inception of it?
All the cost of issuance for the bond issue would be paid out of the bond issue itself. So maybe there might be a few dollars out of pocket that you could reimburse yourself for actuarial costs to work on doing some of the different stress tests that we're required to do. But other than that, other than the actuarial cost, everything else would be paid out of the bond proceeds. So if once the issue closes, then the bond rating agency gets paid, the underwriter gets paid, legal counsel, the actuary, everyone else out of the bond proceeds. So we'd be looking at very limited potential expenditures from the general fund for maybe some of the actuarial costs. But you can get reimbursed for that. We were sort of budgeting 5 to 10. I don't know if it would be that much. But if you didn't make the expenditure, you would be able to reimburse yourself out of the bond proceeds.
Hey, Bill, I'm thinking I'll have to get with Cindy and Christy and verify. I'm thinking that they normally give us our actuaries the end of June. So that being the case, we'd probably have to order an actuary done.
Yeah, I think we would not want to wait for the normal process.
Which we
We
have
want
to
them to
pay
speed it
for.
up.
I think last time we did that, I did it once with the union. It was about, I don't know, $3 grand, $2,500. If I remember right.
Right, because I think the last year, the actuarial report came out sort of the end of May.
Yeah. So if that's the case, once we verify, if it doesn't come out to June 30th, should I order an actuary done like now, or wait till the first of the year, or what would be?
Well, obviously, we would like to make sure that the board wants to proceed before we
Right.
Incur any expense on your behalf. But yeah, I would talk to the actuary and find out how quickly we can get it.
Now, as far as the steps that we do with the board, at what point in time is it do we go past the point of no return?
Really, I'd say once we get into the market with the bond issue.
So we can have you go forward, is what I'm saying.
Yep.
We can have you go forward, and if we don't like what we see, we can say, hey, time out, let's rethink this.
Right. So let's say, we start and the market, interest rates go up dramatically for whatever reason, or there's a big market crash, and we don't want to get in there. Unless we've sold the bonds already, you can just put the whole thing on pause and wait until the market comes back. So yeah, your point of no return is sort of when we are in the market pricing the bonds and we tell the township, hey, here's your offer, your interest rate, market's crashed, it's 8%. How's that look? Well, maybe we don't even meet our 15 or 20% savings,
Right.
15% savings target.
Yeah, I
So
was
at this
going to
point-
ask you what our worst case scenario is for risk to the township, but I think you already answered that question with the market crashing.
Yep.
Yes, the market was away. So the only cost you would have incurred that you're still required to pay in that circumstance is the rating. We will have gotten a rating. And the rating agency, you'll have to pay that cost. And I think, Bill, you've estimated that around $15,000.
Yep.
And then we talked about already any type of actuarial report that we're gonna have done, that would be an out-of-pocket expense that you wouldn't be able to recover. Again, our fees are paid at closing. So if the deal doesn't take place, then we don't charge for that.
And that's the same with our fees.
Right.
So
So-
we would, obviously, we'd be monitoring the market. Steve would be working on updating our interest rate assumptions probably a couple times a month. So if for whatever reason, things were getting away from us, we would know that before we even got into the market. So we would just tell the township, hey, it's not where we want to be. Let's put this on hold until the market comes back and interest rates are better in your favor. So I don't think, it would be real surprising for us to get in the market. There's only about 10 days between when we mail that offering document and when we price the bonds. So we would know fairly well whether or not it's going to be worth proceeding.
Mhm. Well, the market's been up and down significantly and rather quickly at times. And do you foresee after the first of the year, when the new government takes place, what that's going to look like?
Well, one thing I never like to do is predict the future of interest rates. We just really don't know. As you said, 10-year Treasury is up almost 45 basis points since the election. It's still very low, under 1%. The stock market's just been going gangbusters again. If the COVID vaccine comes back, the stock market should continue to do well. The expectation is with the new government coming in that they're going to continue to keep interest rates low, and the Fed's going to continue their buying of assets. So we're not anticipating any major spikes in rates. Not to say it can't happen, but we're not anticipating that.
Okay, so I did check my email and it looks like June 18th was when we got our last actuary report. So I think we just
June 18th?
end in December, but looks like it'd be June before we get an actual report.
I don't know if I missed this on here, but how are we currently, investing the pension money?
That is all done at the state through MERS. So the
Okay.
state is investing your money on your behalf.
So, yeah, it seems to make sense that we'd have a little more control of it this way.
Right, they're still gonna invest those proceeds.
Yep.
But you actually now control, the cost associated with the funds that you're putting in there, right? So you now actually have a good idea as to, now you're taking those levels up to, because if you look at early on, I think, Bill, your page 2 had the different funding levels before bonding for each of the plans, and they range from 55% to 83%. You'd bring those all up to 95%. Right, but MERS is still going to invest those funds because you're going to deposit the proceeds with them, but you'll be at 95, close to 95% on all those plans. So that means you'll still have that 5% obligation to fund annually, and any fluctuations, based on market results could result in a bigger or smaller annual contribution.
What it is, Maureen, and I mentioned this to the board a few times where, we can bond out and get about, pay between, 2.5%, 3% interest. We take that money, give it to MERS, and we constantly pretty much steadily make between 6.5% to 8% interest. So we're basically paying 3% and making, 7% interest. over the 19 years, and that's where we realized the savings. Plus, with MERS, we're so far, well, they say we're not bad underfunded. I think we are, but the fluctuations of payments that we have to make from year to year, it's like a roller coaster. And it's impossible to budget for.
Right.
This will have, okay, we have a payment, we know exactly what it is. It's a lot easier for us to plan for and make adjustments to running the rest of the township.
Yeah, you know, economically, you're in a better position than some of the municipalities that did these a couple of years ago because Treasury's changed the requirements. Investment assumptions 2-3 years ago, most of the investment assumptions were sort of 775. That's being pushed down to your current actuary report was 735. They updated all the demographics for the actuarial tables. So those have been updated. So, and the interest rates at their borrowing cost were much higher 2 and 3 years ago. So right now you're assuming, and I believe it's going down again for 2020, the investment return assumption, because MERS is sort of using the blended rate, if you would, over the last few years. So that's coming down again. So the stress levels are, I think, better for your assumptions than maybe they were 2 years ago when people were assuming 7 3/4 average investment term or investment return over the life of the deal.
Yeah, Artie, that payment that you mentioned, is that a fixed payment or is it fluctuating with interest?
With the bond, it's going to be a fixed payment. But we pay MERS, it varies year to year a lot.
And then OPEB obviously is pay as you go.
Right, pay as you go. So
I asked the simple questions.
yeah. So what, as a board, what would be our next step? Bill?
Bill, I
Or,
think you'd want to know that you want to really start preparing the comprehensive financial plan.
Yep.
I think is really the next step of giving the green light to go ahead and start that process. It's certainly on the pension side, right? You'd wait and see on the analysis on the OPEB side, but you know, starting to get into the preparation of that plan would be the next step.
Yep.
so do you need board action to do that?
You have the preliminary engagement letter we sent.
Right.
Yep, and that would be all I would need in order to begin that process.
Yeah, we approve that.
Yep, so I'm good. I don't know if Tom needs anything else.
Artie, what I do is I just send you our standard engagement letter that said, you know, with the understanding that the township's considering issuing the pension and or OPEB, I'd send you an engagement letter for your review. It would lay it out, you know, our typical responsibilities, which we've talked about here, and then proposed fees for each, which I think Bill's already built into his estimated costs there.
Okay, I would like to make a motion that the board would allow me to sign the engagement letter from Tom Collis to proceed with the financials and the steps on refund the bond issuance for our pension liabilities. Do I have a second?
I'll support.
Okay, does anybody have any questions while we got everyone on the horn? Like I say, this isn't, you know, we're not putting any money out yet. We're far from the point of no return to
Yeah, it's only exploratory at this time.
right,
Exploratory at this point in time, that's all.
right.
Yep, as we go through the process, we would prepare that comprehensive financial plan. We'll continue to update our assumptions and do the stress tests here. And then we would come back to the board with a draft of that comprehensive financial plan.
Right.
Yeah, would we need to approve each step as we go?
So Yeah, there'll really be two approval levels. One will come to the board for the comprehensive financial plan. So there'll be a resolution that approves that plan and authorizes publication of that notice of intent. And then we'd come back to the board for the actual bond resolution. So those would be the two formal actions that we need to the board. Of course, we would keep the board updated with respect to, how those plans look, if there's any new assumptions
Okay,
come in line. But the two formal actions would be approval of the comprehensive financial plan and publication of the notice, and the bond resolution in two separate meetings.
And the point of second return, correct me if I'm wrong, is the second approval.
And even then, so we would authorize the bonds, go to get treasury approval, that you're still not committed. I mean, if the market goes away, we never get into the market, right? So there is, even though we've authorized issuance of the bonds, it's still subject to meeting the 15% threshold. Because if the market goes away from us and we can't get to that threshold, then the deal doesn't happen, right? So.
Yeah.
So as Bill said, the commitment really is we've gone into the market and we've actually signed a bond purchase agreement.
Sold the
Then we're
bond.
committed to actually issuing the bonds. But we will have priced knowing that we've met that savings threshold.
So yeah, there are numerous opportunities, if you would, for safeguards or guardrails on this, where you'll be able to continually monitor the potential savings to the township and make a decision whether to go on to the next step.
okay. That makes more sense. Yep.
Yep, you're not committing yourself to anything at this point in time.
I think Maureen's been raising her hand.
Well, you talked about a $15,000 preparation fee. Does that come into play now or is not till later?
So the actual expenditure of fees will come into play in a couple. One, if you're gonna get the a new actuarial report, the cost associated with that. Two, when we, as part of the treasury approval process, the township's required to actually get a rating on these bonds. As Bill said, you have existing ratings on outstanding bonds, but this specific bond issue has to be rated by a rating agency to get treasury approval, and it just needs to be in the A category or higher. That'll be a commitment. Once the rating agency provides that rating, there is a cost associated with them actually giving us the rating. Now that's before we actually issue the bonds though and get into the market. So that is a cost that you will incur regardless of whether you proceed after that point or not. And once we file with Treasury, Treasury also has a filing fee to file the application with Treasury. It's about $1,000. So in total, you're probably talking, somewhere around 15,000 for the rating agency fee, about 1,000 for the treasury fee, and Artie, whatever number you think you might have for the actuarial report. Let's just say that's 4,000 or 5,000. You're probably talking $20,000 is the universe of what you might incur prior to actually selling the bonds.
Yeah.
So that you
And each one of those issues will take board approval.
No, actually, so what we would do is the bond resolution actually authorizes filing for to get a rating report, filing with the Department of Treasury. So it authorizes the expenditures of funds in those connections. And the resolution also has parameters as to, hey, we actually, we're not gonna, Artie wouldn't have authority to sign a bond purchase agreement unless we meet those parameters set out in the resolution. The major one being the 15% savings.
But all of that would take place after we approve that resolution. We would know
Correct.
we were at point.
Yep, Cindy, that's absolutely right. Yep. So the first resolution is really just kind of getting the process started. We approve the plan. We've approved the publication of the notice. Once we come back to the bond resolution, that's going to have the details, the proper filings, authorization for paying fees associated with the rating agency, if we decide to get insurance or not. Again, that would be down the road. That wouldn't be an expense you would actually pay now. That would be once we issue the bonds, but nevertheless, that would be authorized into the bond resolution.
And these funds would be reimbursable once we sell the bond if we wanted to.
Yes, absolutely right. That's a great point, Harry. So they're considered part of the cost of issuance of the bonds, that once we issue and sell, then you reimburse the general fund or wherever you took those for those costs. Exactly right.
So when you're gonna have to wait until December 21st for that commitment letter to come over to Artie, or?
Well, I just made a motion authorizing me to sign the commitment letter.
Right. Yeah, okay. So I was just wondering when that was gonna happen.
So I'd probably get that letter out to Artie this week.
Okay,
That allows me to internally, we do our due diligence, making sure that there's no conflicts. We open a file internally that, then we can just follow everything properly there. It's again, what we typically do with every bond issue we bring to the township is every time we start a new one, we present a new engagement letter that says, okay, this is the new deal that we're talking about. Here's what our services cover. Here's what they don't cover. Here's what our approximate fees are based on that.
okay.
Any,
Tom, if I could, given the market conditions of today, the unfunded portion of our liability and the current interest rates, are you recommending as our council to proceed with the next step?
So I mean, that's a financial decision versus a legal conclusion. So that's a recommendation that I don't make as your counsel. My recommendation is my role is limited to these are the steps. So I can't provide financial advice. I'm prohibited from doing so. And this is kind of a financial decision as to, the advantages and disadvantages from the market perspective. That's more of what you look to Bill and
Yep.
to say, hey, listen,
Okay.
from an economic standpoint, do these savings make sense to you with the understanding what the risks are either way?
So could you give us a quick extreme scenario of what would have to happen to the market for us not to move forward with this?
Either a combination of a major increase in interest rates and a declining performance in the stock market. So if our cost of funds increase significantly and the market returns, a market crash, a major decrease in the price of your assets, then we would recommend you put it on hold. Say for example, last February when the COVID crisis first hit, and we had roughly a 20% loss in the value of the stock market over a 6 to 8 week period. Had this been in the market at that point in time, we probably would have told you to put it on hold. So we're looking at either a significant market decrease in value or a major increase in rates. And as we said, that's something that we'll have Steve work on, my analyst here that's on the call. And we'll be monitoring that sort of at least twice a month, updating scales and our sensitivity analysis to make sure that we're still close and have a comfort level on that 15% savings target.
Yeah, Chris, I think that's the real key thing here is you have a built-in statutory requirement of 15% net present value savings. So
that was one of the things that changed in the statute from a lot of these that were done prior to the new law. There were municipalities that were doing this, the savings might have been 3, 4, 5%.
Right.
So the stress tests were much closer for them. And that's why Treasury put that 15% in for the pension bonds.
So there's really two factors that go into this, right? What's the new actuarial report going to say as to what your liability looks like? And two, what's the market look like at the time you're doing this? That's what Bill's talking about, a sensitivity analysis. That's a sensitivity to the interest rates of the market. So for example, and you're required to do this as part of the comprehensive financial plan, we'll look and see what the savings do based on what the market does. So assuming, let's say an interest rate of whatever it might be, 2%, if that rate moves to 2.5% or 3%, what does that do to the saving? Because that's another analysis that the township board could look at and say, well, okay, if the market moves by 0.5%, 50 basis points, does that put us below the 15% savings threshold? If it does, we can't proceed. So automatically where the market has to be for you to meet that 15% threshold savings.
Even should there,
fall safe is kind of built into the program already.
yeah, if you have another market decline, say 20, 25%, as Mar already said, the township still has the obligation to make the contributions and pay those benefits to the retirees. It's just that your fluctuations on your payment calculation each year is going to be much more dramatic. By funding 95% of your liability of the pension fund, and now you've got that fixed payment every year, even if it goes down 20%, the fluctuation, if you would, isn't going to be as material or as major as if you were still funding it as you are currently, based on the revised actuarial reports. And that's really one of the major reasons. The arbitrage is nice, the estimated savings is nice, but you really won't know how much you actually saved on this thing until 19 years from now. Hopefully I'll be retired, but you really won't know until the end of this, because the market and your assumptions are really changing every year. One year it looks good, maybe the next year it doesn't look as good. You really won't know until this is over. But your fluctuations, because you have that fixed payment now, and you funded 95% of your liability, your fluctuations are going to be much less.
Yeah, in a perfect world, you're going to earn a strong rate of return. And then even though you funded 95%, hopefully in a perfect world, you've earned enough to cover that additional 5%, right? So that your earnings on your investments in a perfect world would cover that additional 5%.
Additional cost.
Right, but you have the converse too, right? So to the extent that the market moves away from you, you would have originally funded 95%. That's going to be on day one. But the more it moves away, the more the township has to kick in annually to get to that funding level.
Mhm. Could the township pull out of this arrangement at any given time?
Before you sell the bonds, yes.
Yep.
Yeah.
That's sort of the
I
trigger
mean,
date.
okay, after we sell the bonds, we'd have to pay them off in order to get out of it.
Correct. Bonds are sold, you're on the hook.
And that's actually, here's a good point. Maybe this is another way of answering this question. So the bonds will be 19 years out, right? You'll have the ability to pay them off early. Bill, typically you're going to put a 10-year, after 10 years, you can pay off the remaining maturities early if you want to, if you have funds available, or to the extent the market's in a good position, you could refinance the bonds after those 10 years. So that last 9 years, you could potentially refinance it if it makes sense, if there's savings to be able to do so.
Okay.
So yes, you're locked into that, but at a certain point after 10 years, you could pay them off without a penalty, or restructure them going forward for the remainder of the maturity.
Yeah, that's an important aspect. Thank you.
Yeah.
Yep.
Anybody have any more questions? There's a motion to sign the commitment letter to go forward with Miller Canfield Law Firm.
Yeah, hey, Artie, we have a gentleman in the bottom right-hand corner. I think he's your financial analysis. He hasn't said anything. He's on mute, but I don't know if he has anything to say or not, but he has a comment or something. I'd like to hear
Anything you
from.
want to say, Steve?
No, Billy, Bill pretty much covered it all. Yeah, I guess I'll be the one monitoring the markets, making sure that everything is in line going forward.
Okay. Enough said.
I guess I have one more question. Chris asked about worst case scenario, and we're really talking about worst case scenario before we get into it. So worst case scenario after we get into it, and then the market tanks and it stays tanked for a long time.
Mm-hmm.
That's where we're at risk, right? So we're betting on that not happening.
Yeah, you're at risk, but you're at risk in either scenario. If you do the bond issue or not, you, the township, still have that obligation to fund those retiree benefits. So if the market loses 50% of the value and your actuary comes back and says, you've got to double your payments now to the contribution, that's really the same under both scenarios, whether you do the bond or not. You still have that obligation.
I think we're less at risk because we'll be 95% funded with the bond. That might drop down to 90%, 88% funded. And right now we're 65% funded. That liability is going to be a lot bigger than it would be with this bond issue, if that makes sense.
Yeah.
Am I right?
fluctuating payments, so.
Yeah.
Right.
Yeah, we just want to make sure that people don't think that by doing the bond and taking the money and depositing it into the pension fund, that your obligations are eliminated. They're not. We're just pre-funding those obligations.
So,
And that they can change every year going forward, right? So it gets,
right.
the bogey moves on you every year based upon the market.
So if it
The amount that.
Hey.
Go ahead,
If it-
Cindy.
if it absolutely tanks, essentially, we're just buying a bunch on sale, waiting for it to go back up.
Yep.
And one thing too, the state allows us to only bond for 95%, because probably we'll be in 10 years from now, we'll be 100% funded. There's possibility we could be 110% funded. And that's kind of my thinking. That's why they cap it at 95%. If it does tank, okay, instead of 95, we could be 88%. But if the market tanks, well, wherever we're at, we could be in the 50s, like 58% funded. And boy, we're going to have to pay a lot every month.
Yeah, your budgetary impact would probably be more based on the current model.
Right. So,
Hey, Tom, what was that time frame you gave us for going to the marketplace?
You're probably talking a good 4 or 5 months before we're actually in the market.
Okay, so we'll know what's happening by then, that's for sure.
yeah.
Oh, yeah.
Yep. And again, as both Bill and Steve said, they're doing a constant analysis. So we won't go into the market if we don't think the market's good, right? So
Okay.
Before you actually get into the market, there's tons of updated analysis that Steve and Bill are doing. So we'll know exactly, because we don't want to incur those costs for no reason. We want to make sure that, we'll print the official statement and get that marketing started only if we think the market's there. Only if the current rates show that we're there, and that we think that in the next week or two, when we lock in those rates, that savings will be there. Otherwise, it's not worth people's time and effort to do that. So there'll be a constant market review and analysis throughout the process.
Sounds like a plan.
Any more discussion? Are we ready for a vote? Cindy, you want to unmute and do a roll call?
Sure. Joanne Shirkey,
I would say yes, but very cautiously. Watch out what we're getting into. Go slowly.
Maureen Bory,
Low risk at this time, so I say yes.
Chris O'Regan,
Yes.
Christy Hilton,
Yes.
Artie Bryson,
Yes.
Cindy Valentine, yes. Jared? Mark?
Yes.
Okay. That's
Okay,
it.
motion passes. You voted yes too, Cindy?
Yes.
Okay.
Oh, sorry. Did I skip myself? I might have, but yes.
All right. Thanks, guys.
Our pleasure.
All
Have a
right.
good night. And
What's
we'll
that?
get to work on updating those OPEB numbers for you.
Yeah, we'll have, I should have the OPEB numbers from our auditors in a couple, 3 weeks.
Okay.
So,
Thanks for the cheat sheet, Bill. That was, and Steve, thank you. That
Our
was
pleasure.
very nice to follow along.
Thanks, everybody. Happy holidays to you all.
yep, you too. So
Thank
we have board member comments. Mark, do you have anything?
No, I don't. Good job by all.
Okay. Cindy Valentine, you have anything?
Not anything other than our next meeting will be Zoom, since the governor determined that we will not be in
Yep.
our boardroom.
Chrissy, you have anything?
I do not.
Chris?
I guess I'm proud of the group. This is a legacy cost that people have kicked down the road for a long time. This board's not like that. We're a little different than previous boards, so kudos.
Yep. Joanne,
No, I have nothing to say
Okay.
this time.
Maureen?
All good.
Okay, I'd just like to say too, I'm proud of this board. This is, we're aggressive, but I think, like you say, you know, and we have certain elephants in the room. This is really, to my mind, the last big one. And I think this is the best solution for it. What, Chrissy?
I said, knock on wood, quick.
That's right. Hopefully we have no more elephants in the room. And I think this will, if it works out the way we hope it does, you know, saving 19% off of our largest expense in the township for the next 19 years, that's huge. And that's something that if it pans out that way, we all can be proud of. So one other thing for the board, I had scheduled a hearing for the Piper's Act suit going on. That's been postponed. We're looking at a date in January, but we met with legal. I like the way how our side is sitting, and I'm pretty confident going forward. So, if anyone has any questions on that, I can review everything with you. So, just get a hold of me. Other than that, motion to adjourn.
Motion to adjourn, second.
All right. Thanks, Bill and Tom and Steve, and thanks for all the work. And
Pleasure.
I'm
Our
sure,
pleasure. Thank you.
sure we'll be talking to you.
Have a good holiday.
You too.
Bye.
Thank you very much, guys.
Good night,
Happy
everyone.
holidays.
Good night.